Hello everyone and welcome to the True Potential Do More With Your Money show. Today we wanted to focus in on asset markets and some of the key trends and themes that we've been observing as an investment team over recent weeks, indeed since the last time we were here on the 17th of June. I'm joined by a number of my colleagues today from the investment management team, and I'll just ask each of them to introduce themselves now. Starting with George.
George Bell, Portfolio Manager on the True Potential Portfolio Solution.
Chris Leyland, Director of Investment Strategy for the True Potential Portfolio Solution.
I'm Paul Durns, Investment Director, managing the Growth Aligned Portfolio Solution.
Okay, well, let's get into the bones of what we want to talk about today. And really, it doesn't seem like it was that long ago since we were on the podcast, going back to the middle of June, but really there's quite a lot has continued to happen and to evolve. Some of those things that we've been touching on for many months are still there, still very important. And maybe, George, if we touch on those first in terms of just that inflation backdrop that we're seeing and how that has not changed, but subtly evolved over recent weeks.
Absolutely. Great place to start, especially with the reports which we had come through on Wednesday evening, which was in the US, which is demonstrating what are the themes we've been discussing of headline inflation coming down. So the headline inflation rate ticked down from 4 to 3%. But what we're still seeing is what we call sticky core inflation. What does that mean? It means that if you strip out energy and food prices, that actually inflation is not coming down as quickly as we'd hoped. So it has moderated 4.8% relative to the previous of 5.3%. But there's still a number of components which are putting upward pressure. So ultimately, what does that mean? It means for central banks, they've still got an inflation challenge to address because that core level is above the target of 2%. But if we look at momentum in terms of the rate of change that we're seeing, if we take core services, strip out housing costs, which is what the Federal Reserve are particularly interested in at this point in time, it's running at 2.9%. At the end of June. At the end of March, that level was 4.8%. So there is, positive momentum in terms of change in.
And it is quite significant as well when we think about where we were in terms of that peak level of inflation, in terms of the headline rate at north of 9%, and where we are in that data that we got yesterday back down to around, I think 3% is where we are in the headline. Yeah,
exactly. So it's we've been talking about this environment of disinflation, and that it's coming through probably a bit more powerfully in the States than what we're seeing in the UK. In the UK, as we've discussed on our previous podcast, I think we caught the latest inflation print from the UK, which was demonstrating that the Bank of England have probably got a bigger challenge to contend with in this respect of inflation. Rather than core inflation ticking down, it's actually ticking up.
Yeah, and I suppose that's the contrast. We're at 7.1% here in the UK versus that much lower number that we're discussing in the US.
Exactly, and off the back of the results which we had on Wednesday evening, bond markets in the States, we saw yields fall, which is sort of the market maybe taking a bit of a breath in terms of what does this mean for the Federal Reserve in terms of how much pressure is on them to either go up in terms of interest rates or pause, or maybe even further down the track look to ease rates, whereas in the UK, so we say we've still got that upward pressure, and hence in terms of another aspect of another way of looking at this, currency terms, we've seen sterling relative to the dollar move above the 130 level, 131 today. So I
suppose that highlights the lot of different trends that actually spin off just this very narrow discussion around inflation and interest rates and what that means for economies and the opportunities that may create as we look to that. But maybe, Paul, from your perspective, there's also this, I suppose, a contrast in what we're seeing in inflation and different speeds. We've touched there on the fact that there's a large divergence between the UK and the US in terms of that rate of change. Probably the world's second largest economy, China, is in a very different place from its inflation backdrop.
Absolutely. In China, inflation is, I think it's around 0%. So you've seen a collapse in inflation there, and coming into the year Q4 last year, you were having euphoria within Chinese stock markets, up around 53%, just as their economy reopened from their lockdowns, and the expectation was that would facilitate consumer spending, and to the extent that we saw within the US and in developed markets, and that was that euphoria was reflected in stock prices. Unfortunately, as we got past March and into April, the data which had rebounded had started to drop off and started to come in below expectations, and that has continued. And so we've seen a bit more weakness within stock prices, down around 15% since its peak. We've seen weakness within the currency markets as well. So I think if you look at the currency, the Chinese currency versus the US dollar, it's at its 15-year low. And that's just reflective of just very weak demand. Consumers are spending, but it's on smaller ticket items. And therefore, the challenge is now for policymakers within China to really stimulate economic growth, which they are doing to some extent, reducing lending rates, but the demand for credit is just not there. Property developers are taking credit on, but they're just paying down existing debt rather than getting that money into the economy. So the market's really wanting more from China in terms of stimulus in order to get a re-acceleration in economic growth. So that's what we're looking for.
And certainly when you look at that inflation number of CPI effectively zero, and I think producer prices -5%
Exactly.
in that data set, it certainly does illustrate the real challenge that China is presenting. But it's also, I suppose, creates a degree of opportunity in that sense, in that it's not exporting inflation everywhere else, it's exporting deflation. So from that perspective, it's maybe a slight net positive at this point in time. And Chris, we were just talking earlier around China, and you had a few other points that you wanted to bring out.
One of the things that we've just been discussing really as a team is the kind of localization of supply chains. So what I mean by that is, if you're, say, a firm, you're based in the US, you're buying products that maybe make your main product from China, you may have had a rethink during zero COVID because you may have not been able to actually buy those products. You may have a rethink because of relationships politically between US and China. So what you have seen is actually some of the bigger companies start to move some of their supply chains away from China overall. So that's maybe another reason that you haven't seen the kind of manufacturing side of China reaccelerate maybe as quickly as what people initially thought. I mean, one other thing that we were discussing with some of the fund managers was almost a bit like the kind of psychological effect of being locked down for so long, and maybe not initially wanting to come out and spend like we did, or consume like we did, or travel like we did, and instead actually being quite nervous about the potential of COVID reappearing. So the market was very focused around this massive rebound that literally didn't come through.
I suppose you've got to contrast, with just the fiscal policy that was enacted within the US, where physical checks were given to all households 3 times, I think it was. If you've received a check, you're going to most people are going to go and spend that, or save it and spend it at a future date. Chinese households did not receive that, so there is a big contrast.
And I think maybe the other thing to bring out there, Chris, is the political environment is certainly in the US from that fiscal perspective. It's supporting US businesses to invest in the US, so that, if you will, onshoring and movement away from China is being facilitated politically by the Inflation Reduction Act as well, and the tremendous subsidy, if you want to call it that, that's provided to companies to bring back facilities to the States.
Because that was, in the handing of the baton from the Trump administration, the Biden administration, a lot of expectation is, will the sort of make America great again aspects start to fizzle out, but Biden carried that on, and a lot of the fiscal intervention has really been America first in that regard.
It's interesting, I was just reading a report yesterday, and it looks at how the trade relationships have started to change, and for the first time in many, many years, China is now not the US top trading partner. It's now Mexico. For the reasons, I suppose, that we're discussing. It's much closer to the US by virtue of the border. Manufacturing in Mexico back up into the US certainly seems to be a well-trodden path historically, but seems to have really accelerated recently as well.
And I think that's, for ourselves as global investors, it provides opportunities. So whilst China might not have been the place to invest over the last 6 months, if you look at the likes of Mexico, Brazil, some of the LATAM countries that have pushed interest rates up quickly, earlier than developed markets, and therefore benefited from the disinflation forces coming through, but also their economies benefiting from some of these new initiatives within the US.
And certainly then maybe bringing it back to equity markets in that sense, if we look at how the S&P's performed, how NASDAQ has performed, yes, at a headline level it looks as if it's performed very well, but we also have to look at the breadth of that. It's been really quite a narrow market in terms of the number of stocks that have really moved the index forward. And George, you were just talking about that yesterday in terms of how tight and narrow that is.
Absolutely. Take 500 stocks in the US, the majority of the leadership's been taken by 7 companies, 7 companies who are essentially very closely linked to one of the future development themes, which is artificial intelligence. And they've delivered over 50% year to date, whereas strip them out, the rest of the index is nearly flat in that regard. And the challenge we see around that is the valuation which is now placed on those companies. We fully understand the theme, and we're capturing that theme in some of our managers, say Pictet as an example, and the way in which they invest in their thematic products. But if you take a company, say Nvidia, which is one of the 7, price to earnings multiple of 40 times. Now essentially it's 40 times to get your investment back from the earnings alone, assuming no change to the base capital cost or taxation or whatever it may be. Take, say, the US as an equally weighted basket, you're looking more like 12, 13 times. So it's a stark difference in essentially what it is.
I suppose just to remind everybody, those other companies that fall into that, it's Microsoft, Amazon, Facebook, Google, and one other, Tesla. To bring out the 7. So those are the names that have really powered the index forward. Paul, maybe turning to you and thinking about what does that mean in terms of economic growth and how growth indicators have evolved over recent weeks. Certainly bit of revision in the US, which has been a positive.
Yeah, there's been a whole host of data that's just supported resiliency within the US economy. We had a revision of the Q1 GDP data, so that's a measure of economic growth. That got revised, I think it's got revised 3 times, but the last one got revised from 1.3% to 2% on an annualised basis for Q1, and that's really been facilitated by stronger consumer spending and exports. When we look at the economic data, employment has stood out as being really strong, and we saw that last week with the jobs data, with the ADP report, just short of 500,000 of jobs added. Last month we had the non-farm payrolls, which is the government official jobs measure, that added 209,000 jobs last month, so a little bit softer, and a lot of those jobs coming through the government sector, but on the whole very, very strong, and that can help facilitate consumer spending going forward. When we look,
sorry to interrupt, but that probably is the difference between what we're seeing in the US if we contrast that maybe with Europe, in that you've got disinflation coming through, but economic growth continuing to look pretty resilient at this point in time.
Yeah, definitely. If we look at the survey data, so the PMI survey data, look at the US, services particularly very, very strong. Manufacturing not as strong, but when we look at the European data, we're seeing misses. So readings coming below what economists are expecting. Not necessarily you've got challenges with the inflation front. You're not getting the support from China that you once would have got, which would have been beneficial for Europe, particularly given the exports route. So there is a real contrast, and speaks to what we're seeing at the minute. Is just an unsynchronized environment globally when we think about growth, interest rates, inflation. So that creates challenges in itself, but also creates opportunities, and certainly why we believe in being diversified across different regions and different asset classes.
And maybe just to link that growth picture to the earnings picture, we're at the start in the earnings season probably in the next couple of days within the US, and maybe George, just from your perspective, what were people expecting there, and how have things evolved?
Yeah, I mean, we've had I think we've had just under 100 companies which have reported so far, and there's a number of companies who are providing more positive guidance, especially in the technology type space. If we look at expectations for technology for this year, they are flat at this stage, but if we look into next year, expecting earnings growth of around 15 to 16%. So a bit more optimism starting to come through in that regard. The areas which are going to be more challenged from an earnings perspective this year are energy. If we look at guidance in the US, energy sector is expected to be down about 28%, but then...
And I suppose we shouldn't think about that as being a bad thing from an inflation perspective.
Precisely.
It's been so helpful to see energy prices
Exactly.
return to more normal levels.
Exactly, yeah. So if we look at essentially what we're saying is 2023 earnings are forecast to be relatively flat.
Yeah.
But if we look into 2024, which is important for how we're thinking about investments, with markets being forward-looking, US expectations are for around 12% earnings growth, and when we're looking at those expectations, we've certainly seen a negative trend occurring for the last number of months, and then over recent weeks we've seen that start to bottom out and actually some positive signals start to come through. So I think it's just an example of companies are agile, they'll adapt, and they'll look to innovate and deal with the fact that they've got higher financing costs and base
certainly
costs.
over the coming weeks we'll bring that to life as well. And
exactly, there'll be some big names which are reporting.
We'll start to see the reporting come through. Maybe to move the conversation on a little bit, Chris, to bring you in then and think about sort of the portfolios as well, and how changes have maybe been made there over the last month in particular. Because we've got a lot going on, as we've all discussed. There's many trends evolving within markets, within economies. As Paul was mentioning, there's real divergence in policy and economic trajectory. And how are you dealing with that within the portfolio solution, and how are our managers thinking about that?
Yeah, it's a good question. I think Paul's exactly right by saying that actually that divergence is bringing up opportunities. And I'm pleased to say that both us and the managers that we work with are absolutely taking advantage of those opportunities. So if we just think around, what are the sort of key changes that we've seen, say looking back over the year, you've seen a mild increase towards equities overall, so towards company shares, and you've seen more of a focus on US equities, but also Japanese equities as well.
Maybe bring that to life a little bit. What does that mean for somebody that's looking at the balanced portfolio in terms of equity exposure in totality, how that's changed, and what does it mean for them?
Yeah, so I think Paul is exactly right. What we have seen is a lot of divergence, and that divergence is bringing up opportunity. I'm pleased to say both we, as in all of us in here, and the wider True Potential investment team have taken advantage of that. But also all of the managers that we work with as well have taken advantage of that. If we look back to the start of the year, we look at equity weightings, it would have been around about 55% within equity, which is quite low compared to history overall. But those equity weightings have climbed up, so we're now around about 57%. If we look at which regions have been the key beneficiaries in respect of that, probably say two. I'd say the US and Japan. So US, we've discussed earlier, we've talked around economic resilience, we talked around the resilience and potential, you can almost call them defensive characteristics of the stock market. One thing I would say though is what we've seen from our managers is certainly over the recent time period, maybe less focused around buying the whole S&P 500 index, trying to be a little bit more thoughtful around valuation. So trying different ways of playing that.
When you say they've been thoughtful about valuation, what does that mean for our listeners in terms of how you can access the market?
Yeah, absolutely. So when I say thoughtful around valuation, obviously, George talked a little bit before around how you'd seen a basket of stocks perform incredibly well.
Yeah.
So they're now quite highly valued, so they're quite expensive. Now, our managers are saying, actually, we want to access the US market, but we want lower exposure to
Okay.
those more highly valued stocks. So how can they do that?
Yeah.
There's various different ways that they can do that, but probably the favoured way right now is they basically buy the US index, but they equally weight the individual sectors. So as you can imagine, if you think of the big sectors that are within the US index, things like consumer discretionary, information technology, etc., that collapses some of that exposure and it gives you a much more balanced exposure overall. So that's the US. You've seen quite a lot of managers actually really interested in Japan. That's been a really good trade as well. Japan's performed well. Probably two pieces of rationale around that. I think the first piece is really earlier in the year, very focused around good entry points, so cheap valuations, so lower entry points. And then the second thing is just really around what you're seeing with Japanese companies is they're becoming a lot more shareholder friendly.
Right.
You know, if you think back 10, 15 years ago, you know, even longer than that, you know, Japanese companies were maybe a little bit more loath to pay dividends. They like to store cash. You're starting to see them pay dividends more, which is obviously good for overall shareholder return. You're seeing a lot more companies really being pushed to be shareholder friendly, which is a good thing.
I suppose the other side of that was we've seen the equity market or the local market perform well. If we think about the strength of sterling relative to the yen, it's been quite material over that period as well.
Yeah, absolutely. I mean, if we look at how the yen's performed, you look at it versus sterling, you look at it versus the dollar, you've seen quite a bit of yen weakness come through overall. You know, if we look at where we are right now, that kind of 145 level versus the US dollar, what you're seeing there is, you know, the potential for actually a lot of our managers think that's a good entry point. There's potential for the yen to strengthen from here.
Yeah. Okay. And then maybe George, just from your perspective, anything else you'd like to sort of bring out from what we've been doing within the portfolios, maybe thinking about income and things like that?
Yeah, absolutely. I mean, you know, the review of the points Chris is making is essentially we've built exposure to pigtail moderated, 7IM in the core, and two of the plus models in the income portfolios. The main changes we've been making there, the way our income portfolios are constructed, we've got two. We've got a cautious and we've got a balanced, and they are made up of the same 6 active funds. We've got 3 which sit in the cautious category, 2 in the balanced and 1 in the growth. They're all active funds, so the managers, we give them the flexibility to achieve the investment objectives in a way which they view as appropriate. So we want their skill set essentially, and we want them to invest in the way which is appropriate. Now, to Chris's point, our managers have been moving less defensive relative to their long-term reference anchor. Their long-term reference anchor is essentially a portfolio, which they'll say over the next 5 years, we believe this will weather us through a range of different market environments, and we'll navigate around that. So our managers, rather than saying or piling into risk assets, are moving less defensive in terms of their positioning, and taking that balance in our income solutions where you've got a range of different risk profiles. The changes we've made are really to bring our portfolios back into what we believe is a suitable allocation of risk within those bands. So within cautious, that's meant we've moderated the level of risk which we're taking, and that's by reducing some of our higher risk managers. And in our balance solution, we've actually increased the level of risk towards that level by reducing lower risk and increasing. And in the balance solution, you know, the way in which we've done that is, you know, we've increased the level of risk, but we've done it in a way which increases the level of expected return and also the expected yield which can be delivered.
And that's
in that.
That's maybe an important point to draw out, because that's being forward looking, and I suppose that's exactly how we want to position the portfolios given how markets are forward looking. We've also got our calls ongoing with our managers at the moment, and is there anything that we're picking up there that speaks to the future as to how they're thinking about setting up their portfolios, or some of the points that they're identifying as crucially important for them?
Yeah, absolutely. I think, you know, what we do is we're in an incredibly favourable position in that we speak to our managers very regularly, and within that, really what we're looking for is, you know, how are they thinking around things moving forward, which is exactly your question. How are they thinking around the global economy? How does that then filter into positioning? asset class views, which asset classes are they finding quite attractive right now. So if we just look and we think around the recent round of meetings that we've been through, so we're actually in the middle of that right now. We've got the final one tomorrow. I'd say the key points are that the managers in aggregate are seeing that the US recession is potentially pushed out further. What you're also seeing is a view that we are closer to peak levels of interest rates in the US. What you're seeing as well is, again, maybe filtering into some of the things that George was saying, there's less willingness to have significant defensive positions within their books overall. So you've seen a lot of that being closed out. And the reason for that is the forward-looking view.
And would that be, when you say defensive, etc., that's maybe more in their equity allocation? Or is it as well as equity and credit? Because we have seen managers look to add sovereign exposure given the yield level that George has been discussing.
Yeah. And it comes back to, our approach, the managers inform a lot of, our knowledge and awareness given the research centres which they have globally, but also just our valuation framework which we have, which looks at different assets and how much essentially you're paying for them relative to their long-term history, the valuation. And what we're seeing, especially in areas like credit market, which is corporate bonds issued by companies of different credit rating, is actually the opportunity which we saw early in the year because they were cheaper. We've taken advantage of, as has the market, and that valuation has become a lot tighter. So a number of our managers are expressing that view, which is of a less defensive one by using equities, but almost barbelling some of that through the use of government bonds or sovereign bonds. And I think the interesting aspect about sovereign bonds is, last year it was a really challenging environment because they were positively correlated to equities, which over the long term they should be negatively correlated. And what we've seen over the last number of months is, periods where we've had that negative correlation back. And we talked about alternatives a lot last year, which is a great tool in our multi-asset toolbox relative to a number of passive product providers. The diversification benefit of alternatives is important structurally long-term in our portfolios, but tactically it's given us the opportunity, along with our managers, just to moderate alternatives and use that equity bond barbell a little bit
and
more.
Those are certainly some of the things, Paul, you've been doing with the team in terms of the growth aligned range as well.
Yeah, absolutely. We've been doing a number of those in both equities, in credit, rotating a little bit. This week coming out of US high yield a little bit, just allocating a little bit more into equities where we think they can benefit from improvements in earnings going forward as the US economy appears to be continue to show resilience. Fixed sovereign bonds is more attractive given where yields have been, particularly at the short end. If we think about UK gilts and where they've repriced, having to price in much higher interest rate expectations, so gilt yields have gone up. They're looking a bit more attractive, particularly at the short end, because they're less influenced by the inflation outlook. So a lot of opportunities from growth aligned. We've continued to lean within the US equity market, wanting to pick up some of that quality bias, but also being mindful of valuations as well. We've added a little bit to small cap over the last 4 weeks, added a little bit more to the S&P equal weight.
I think that's one of the other asset classes that maybe we haven't had to think about over the last number of years has been cash.
Yeah.
And certainly, as you say, front end of the market gets you close to that cash rate. But how are we thinking about cash as an asset within the True Potential portfolio solution and how that's used by the managers and yourselves, Chris?
Yeah, I think obviously I'm going to state the obvious now, but yields are higher on cash. So if we think around cash within the True Potential portfolios, I probably bucket it into 3 different buckets. So actual physical cash, which is held with our custodian, which is used for trading. So that tends to be a slightly lower amount. As well as that, we've also got cash in what we call money market or liquidity funds. So potentially earning around 5.1, 5.2%, depending on which money market fund that you look at.
Yeah.
And then as well as that, we've also got cash parked in short-dated bonds, so short-dated UK gilts, short-dated US
And when
Treasuries.
we
So
say short-dated, what do we mean in
less
terms
than
of
a year.
Less than a year. Okay.
Yeah. So for us, cash is an asset class.
Mm-hmm.
It's something that we invest in. It's not just something that's kept on the side that's used for trading.
Mm-hmm.
We're conscious that yields are higher,
Yeah.
and that actually holding cash in that sense is certainly much more attractive than what it was 2 years ago when you were basically getting no return at all on cash.
Mm-hmm. And I suppose over time, however, you don't want to hold cash for the entirety of your investment life. How do we think about that?
Yeah, I mean, we were actually talking about this before, weren't we? We've been looking at quite a lot of studies of cash versus equities and how does that look over the very long term.
Yeah.
And I'm going to pick the very long term now. So one of the studies we were looking at went back to 1900.
Mm-hmm.
So you're basically looking at over 120 years worth of data, and it looked at equities versus cash. And on an annualized basis, equities had outperformed cash by 5.9% per annum.
Yeah.
Now, if you think back over that time period, there's so many different interest rate environments
Certainly.
that you're going back from. So it's not like you're sort of just cherry picking a certain environment, say, over the last 20 years or something like that. What you are doing is looking at it over the very, very long term. But the key is, for people to beat inflation, they need to be invested, and they need to be invested in risk assets overall. Yeah. And that's what we offer here at True Potential with the True Potential Portfolio Solution, the True Potential Growth Aligned Solution.
But for an investment solution like a pension, which is held beyond retirement, it's not a million miles away from the term you would hope to carry that for.
Yeah.
And if you pass it down to your children as well, it is that term.
It is, certainly. Sorry.
And no, just in terms of how we've been thinking about it, think about last year, we had very high cash levels within the portfolios, but as we started to see that inflation fall, we've seen the opportunity now within bonds, especially where bond yields are, but also the correlations bonds are having now with equities, as we saw in March when the banking crisis kicked off. Bonds can actually offer you diversification once again, which they typically do. They didn't do last year, but they are doing this year. So from a diversification and portfolio construction perspective, there's real value in owning bonds today.
Thanks, George, Chris and Paul, for that useful and very insightful view about what's been happening in markets over the recent couple of weeks.